Hi everyone, and welcome. Welcome back to my lecture series. Today we're going to learn about the final step of the accounting cycle, is closing the books. If you've watched the beginning, debits and credits, and then adjusting entries, and now we're dealing with closing the books once the accounting cycle is over. So what do we have to do? Well, the closing process is typically done at the end of a company's fiscal year. A fiscal year is an accounting period that is 1 year long. It does not have to be January to December. It does not have to be a calendar year. It just has to be 1 year in length. So you could do July through June, like some vacation destinations do. And then, of course, you have the department stores who like to close at the end of January and make their fiscal year, starting in February, ending January 31st to allow for those the sales after Christmas. But most companies actually do close their books using the calendar year, which is December 31st. So whatever year end you use, the final step of the accounting cycle before you can start another year is to close out your books. So this step is going to involve closing out what is known as temporary accounts through journal entries and then posting them to the Ledger T accounts, and then preparing a post-closing trial balance, your final and last trial balance that you'll have to prepare. So what's a temporary account, and then what's a permanent account? So the temporary accounts are the ones that we're going to close out. These include your revenue accounts, your expense accounts, and your dividends. The reason why we close these out is because it only relates to that period, that year that you're accounting for, that month you're accounting for. And then when you start the new year, you have to start your revenues and expenses at zero to see how much you're making for that particular period of time. Now your permanent accounts or your balance sheet accounts, those are not going to be, closed out in the future. Those balances are going to remain permanent and ongoing. You're going to carry them forward into all the future accounting periods. So if you think about why, think about cash. A company is building up their cash. Well, at the end of the year, do you want to close out cash to zero and then start with zero cash going forward? No, that's an asset. You want to carry those balances forward. Same with your liabilities or your debt. I mean, we'd like to wash out our debt at the next period, but we can't. We have to carry forward those payables. So all your balance sheet accounts and your retained earnings, your ending retained earnings, is carried forward into future periods. Okay, so going back to my original Café Crazae, when I did the adjustments, we're going to close out the books for this company. There are 4 closing entries. Every company will do 3, and then they may do 4, and I'll show you why. The first one is going to be to close out revenue. Well, to close out revenue, it has a normal credit balance, okay? So to close it out, we're going to find the balance, and we're going to do the opposite to it. So to close out revenue for Café Crazae, we're going to debit revenue for $5,600 because it had a credit balance of $5,600. We want to make it zero. Now, the corresponding credit here for the closing entry is going to be credited to this account called income summary. Now, income summary is also a temporary account, and it is only used in the closing process. Okay, so we're going to close it out as well. So it's just, basically, used for this process, and then we're going to close it out as well. Okay, the next journal entry, so there's 4. The second one is going to be to close out all of our expenses. And this might take a little while because some companies have lots of expenses on their books. So the debit's going to be to income summary for the total of all the expenses, and then the credits are going to be for each one. We have salaries expense $1,600, depreciation expense $200, insurance expense $100, supplies expense $300, and utilities expense $200. I think that's it. Yes. So those are all the expenses that this company had. So we take their ending debit balances and we credit those balances to make them all zero. And then we add them up, and that's your debit to income summary. Now, if you look right now and you take the difference between $5,600 and $2,400, you're going to get $3,200. And what is that? Okay, well, that is your net income that you made. if income summary is going to be, you know, a higher credit balance, that means you made a profit for the month. So we're also going to close out income summary for that $3,200, and we're going to add that $3,200 to retained earnings. Well, this entry, journal entry 3, this is the process of taking that net income from the income statement and adding it to retained earnings. This is how it gets into that account. If it were a net loss, we'd be making a debit here to, you know, $3,200, $2,400, whatever, and then the credit would be to income summary. But this is a profit, okay? Our revenues are higher. So again, the retained earnings account is used, but it is a permanent account. But this is how we put net income into retained earnings. Okay, we see it on the body of the statement, but the journal entry is not done until the closing process to put it in that account. And then last but not least, a company may or may not pay dividends or take a withdrawal. If they do, you have to also close out the dividend account. It's a temporary account, and we deduct it from retained earnings. So you see that permanent account coming back here. We're going to debit retained earnings, reducing retained earnings as a normal credit balance, and we're going to go ahead and wipe out, or, you know, credit dividends for $600 to make it 0. So those are the 4 closing journal entries. The fourth one, again, only if a company pays dividends or takes withdrawals will that one be on there. But these are the 4 that are required at year end. Okay, so now we move on to the last and final step before you can start a new accounting period. We have to post all those journal entries, those 4, into their T accounts, that tedious process, and then we have to take and make a post-closing trial balance to see if we did the closing process correctly and make sure we don't have any errors. So in looking at the post-closing trial balance, I'm going to go ahead and pull it all up here. All the balances that we have left are those permanent accounts, our balance sheet accounts. None of those income statement accounts, revenues, or expenses will be on this post-closing trial balance because they now all have a balance of 0. So if you look here, we have all of our permanent accounts, our balance sheet accounts listed with their appropriate ending debit or credit balance. So we have cash, $2,700, accounts receivable, $4,200, Café supplies, $600, prepaid insurance, $1,100, Café equipment, $6,000. Those all have debit balances. Those are assets. Then we move over to accumulated depreciation, $200, accounts payable, $2,400, salaries payable, $400, common stock, $9,000, and then our ending retained earnings is $2,600 after we added that net income and subtracted those dividends. So we'll add up our debit column and add up our credit column, and if it equals, we can move forward into the next cycle, and it does. So that is the remaining step of the accounting cycle, the closing entries. Thank you guys for watching. Don't forget to like and subscribe, and stay tuned for some more accounting videos.